have them as part of the conversation today. Of course, putting out the message to help investors get invested and be informed as they do so. So we're very grateful for ProShare and WebTV for their partnership. We also have excuse me, ABR, which is the AfricaBusinessRadio.com. It is a web-based radio station, and we are delighted to hear that this event is also being broadcast on that platform live as we speak. We also appreciate techeconomy.ng and BrandSpur for their partnership. So we're really delighted to have them support us as we take this conversation forward. And of course, the theme is very apt. Just looking at a couple of data points that I was able to extract from the ZCRES group. I understand that assets under management for the entire asset investment management industry in Nigeria is somewhere close to 2 trillion naira. But if we think about current and savings accounts, that number is closer to 12 trillion. Now, at the risk of having this event cannibalize the current and savings accounts of banks, I think that says something about the depth of the investment management business. And this is one of a series of events that the ZQuest Group is organizing to draw attention to this very dynamic. And we're delighted to have our speakers and our partners, and of course our panelists getting involved in today's event. So we'd like to make this very efficient. Within the next 2 hours, we should be done from from start to finish. And I would like to, without further ado, welcome now Mr. Gbenga Adigun. He's business head at Zimvest, or ZCRES Investment Managers, and he will be delivering a welcome address to set the tone for this morning's event. So on that note, it's over to you, Gbenga.
Thank you very much, Wale, for that. Good morning, everybody, once again. We immensely thank you for finding out time to make it to this event. You could have been anywhere else this morning. So as a first of the many series of what we are going to be doing regarding thought leadership, this first one is themed The Economic Landscape and Investor Preferences in Post-Pandemic Africa. So once again, my name is Gbenga Adigun, and I'm the business head of ZCRES Investment Managers, trading in the name and style of Zimvest, a name that is becoming a household name in the Nigerian finance space. And I am also the host of this event. We are very happy at how far we've come and what we've achieved in a very, very short time.
This audio is fine now.
Zimvest is a subsidiary of the ZCRES Capital Group and is a SEC licensed and regulated funds or portfolio manager. The COVID-19 pandemic has changed the world as we've known it for many decades. Many dislocations have happened. And in many industries, from hospitality to the airline to transportation and even to the food and agriculture industry, these dislocations represent discontinuities in the orderly evolution of an industry or an economy. So has the finance industry been spared? Not at all, definitely not. In fact, that is why we have gathered here to continue to seek clarity in these uncertain times, whether you're on the sell side or whether you're on the buy side. Countries around the world are spending record amounts on stimulus packages. The US government, for example, has spent about $2 trillion already in stimulus packages. And we heard the other time, Donald Trump said they might need to spend another $2 trillion, maybe say around July. By the end of this year, who knows if even $10 trillion stimulus package would be enough for the US government to stabilize its economy. Nobody can really quantify the damage this pandemic would do to economies because guess what? It is simply not over and the dislocation is continuing. And that is why for so many people, there's been lots of confusions and uncertainty regarding what should be their next moves as they are looking ahead. Again, this session is one that helps everyone to help everyone. Have you lately wondered, what are the implications for Nigeria's fiscal and monetary environment? How will ensuing policy pronouncements impact the typical investor preferences and the broader investment landscape? How does it impact or affect me as an everyday citizen? Have you also questioned, as an investor, what should I be buying now? And how should I be managing my money? What are the emerging investment opportunities that may compete against the traditional investment products that I may look at? How do I see or identify safe investments while attempting to grow my wealth? As a finance house, you may have inquired, what decline with declining yields and rapid foreign exchange movements, how can product development and service delivery evolve with the changing needs of the customer/investor? What current or potential collaborations can we harness further with players inside and outside our industry? So this session shall attempt to answer all of the above questions and many more in the next 1 hour or so. We have with us very, very accomplished industry representatives who represent both the regulatory side to the buy side and the sell side. For example, you've all seen the adverts, the advertorials that we did before now. You've seen the big names from Bola Onadele Koko to Iniebong. We have Adeola Ajibade, Onome Komolafe, Esiri Agbeyi, Chifo Ejiofobiri. We have Adeton Dosumo, and of course, our chief host, Adedayo Amzat, our very own. So as we move along, a more in-depth or elaborate introduction will be made for all of our panelists and speakers and by our moderator. So please, we are begging you, sit back, relax, and enjoy the session. It's going to be a very promising and wonderful one. And we want you to be able to say at the end of this session that, yes, I came, I got engaged, and I learned good stuff. So thank you and enjoy the program. Wole, it's back to you.
My apologies. I just realized I wasn't my mic was still muted. So thank you again, Gbenga, for that introduction. I think very apt, very concise, and I think it covers all the bases. And as you mentioned, we want to get right into it. And I would like to now introduce our first speaker, someone who needs very little introduction if you are involved in Nigeria's financial service industry and more specifically, the financial markets. He is the chief executive of FMDQ Group. He's also the chairman of FMDQ Private Market Limited and also serves as a non-executive director on the boards of FMDQ Securities Exchange Limited, FMDQ Clear Limited, FMDQ Depository Limited, and IQX Consult Limited. And of course, prior to getting involved in the FMDQ project, if I can put it that way, he was the president of DHL, a financial market and risk management consulting firm, which he founded in 2001, where he provided business leadership in the empowerment of Nigerian financial markets. His career spans well over 26 years across Coopers and Lead Brands Associates, Chartered Accountants, Citibank Nigeria, FCMB Limited as treasurer, was also involved with Trust Bank of Nigeria as CEO, and Lead Bank PLC, where he was the Chief Operations Officer. He is also a member of the Board of Trustees of FMDA. Please welcome, as he kicks things off for us, our key speaker for today, our keynote speaker for today, Mr. Bola Onadele Koko.
The speakers and talked about our various functions in the ecosystem, and he mentioned regulator. I quickly looked at the list to see who the regulator is amongst us, and I couldn't find one. I hope it is not FMDQ that has been taken as a regulator. Whilst we have a bit of regulation with our members, we actually do see FMDQ more as a market organizer rather than as a regulator. Of course, we know the importance of regulation for market conduct, but that is not untied to our vision, and that goal is mostly organizing the markets. And I guess that's why my keynote address is on the impact of COVID-19 on financial markets. I will spend some time on this. And the paragraphs, the way I'll go about it, I'll speak to the overview, because Dayo, when we spoke, said he wanted this to be about Africa. And I asked him essentially why Africa. I think when we deal with capital and asset management, we have to start understanding that it is global. It's got no borders. So I will look at the African markets. I will look at and then bring it home, look at the Nigerian markets, and then, sort of talk a bit, speak a bit to what is going on in Nigeria, and then end it and hand over to the panelists. And I think we've got quality ladies and gentlemen as panelists this morning. We indeed live in an interesting world today, and the times are very interesting indeed. And the last 4 months have revealed the state of financial market structures in Africa and how the landscape has been evolving to cope with the shocks they have been subjected to. But by various countries adopting measures to combat the devastating health impact of the coronavirus, inadvertently, this threw up serious economic implications for the whole world at the same time. By and large, African economies have faced similar challenges due to a large dependence on imports and large informal population. The difference, however, is the degree to which each country's economy was brought to the brink. In recognizing the devastation the pandemic could have on poorer countries, mostly in Africa, G20 finance ministers and central bank governors committed to suspend debt payments for the rest of 2020 for countries requiring forbearance, provided IMF support packages, and also supported the World Bank and other development banks and initiatives of more than $200 billion. Inadequate as this gesture was, it was estimated that the temporary halt in debt payment would at least free up close to $20 billion, which most of the African countries could then spend on improving their health systems and deal with the current emergency. We all can guess how quickly it is you can fix your health system, but I guess we're all trying as much as we can. So let us look at the African commodities. Prices, capital flight, halt in remittances and tourism. The list is endless. 10 African countries count crude oil as one of the most important commodities, and most oil producers are still recovering indeed from the 2014 oil prices collapse. So you can imagine what's going on. Crude oil accounts for 90% of Nigeria's exports and about 65% of its revenue. About 2/3 of revenues retained by federal government go on debt servicing. And this was when we had crude at $57 per barrel. With the reduction in crude oil production by almost 20% and decline in price by almost $20, revenues are set to drop by about 35%. So with the effect of currency depreciation not factored into when it was 2/3 of revenue on debt servicing, one can imagine a fraction of federal government's revenue that will now be expended on debt servicing. And I believe the panelists will think through and speak to the issues of some of this, the implication of what we're beginning to see with the macroeconomics. Angola is the second largest oil producer in Africa, and the forecast already is that for the fourth consecutive year, even without COVID, the economy was going to contract. Ghana and South Africa are luckier because the price of gold has increased from March, as everyone considers gold as a safe haven during this period. The prices of other metals such as tin, zinc, and copper have also been on the decline since March. So you can think of countries like DRC and Rwanda, the situation with those countries. Let's speak to the markets very quickly, because those were devolving into a tailspin since COVID. We'll start with the equity and fixed income market in Africa. And on the back of the volatility amidst the uncertainty, the African market struggled to grasp the rapid impact of the outbreak. And this was marked with repricing, which occurred across all the asset classes. Again, with less liquid assets facing the largest price adjustments. Investors, as expected, took flight to safety, and they went towards the safest assets as their risk appetite for riskier assets disappeared. This prompted the World Federation of Exchanges to release a statement in March stating that volatility levels were comparable already to what we saw in 2008. In actual fact, there was a particular day where the losses witnessed was comparable to what was seen in 1987. Circuit breakers were encouraged to discourage disorderly markets and to allow some cooling off in the markets. The African Securities Exchange Association reported volatility, significant volatility across exchanges in Africa, and also encouraged some resilience and some resilient measures to be put in place, depending on the peculiarities of the markets. In South Africa, the Johannesburg Stock Exchange, the JSE, widened its circuit breaker trigger points, halting trade periods for 5 minutes at a time to still allow for continuous trading despite the high volatility. And in Nairobi, we saw the Nairobi Stock Exchange doing same after a massive investor panic as the first case of the virus was announced in Kenya. In total, I think equity market capitalization worldwide dropped and I think has lost about $17 trillion in just 52 days. Again, for all of us in investment management, we do appreciate the interconnectedness of the economies and the severity of this pandemic and the rich diffusion of information at this time. Have really encouraged market jumps and very high levels of volatility. This is the new world, and social media has contributed, fanning fear and misunderstanding at the onset of the pandemic, which incubated anxiety and fueled the collapse of investor confidence. Prices of risk assets fell sharply in the equity and fixed income markets, with some recovery being witnessed in the last couple of weeks. However, sentiment seemed to still be very fragile. From what I've said so far, on the situation of Africa and the movement of capital, it is expected from the previous position that there will be capital outflows. And indeed, all across Africa, we've seen unprecedented outflows in terms of size and also the speed with which they occur. In actual fact, the IMF recorded that about $40 billion of flows have left emerging economies. The prediction is that there's going to be massive decline in foreign direct inflows, and this may be between 30 and 40%. And we may see this situation getting us up to 2021. The massive sell-offs were witnessed in East Africa as foreign investors who made up about 70% of daily trading on the Nairobi Stock Exchange actually became net sellers of equity. The same trend was observed in Tanzania. Remittances and income from tourism are drying up fast, or we can say have dried up, with air travel grinding to almost a halt. Again, that is expected with all the travel restrictions all over the world. Tourism contributes $200 billion to Africa's economy, and remittances have contributed $82 billion. You agree with me that this is some financier of some sort to those economies. In terms of foreign exchange, let us spend some minutes to x-ray what is taking place. With the lockdown restrictions in place in most countries, demand for goods and services was vastly reduced, and widening of bid and ask spreads in FX markets where they've been trading, absence of depth in order books, and the inability across several markets to execute large transactions without a corresponding price adjustment pointed to a tightening in liquidity. Most African central banks embarked on monetary policy easing methods and chose to ease the stress in the short-term funding market by reducing banks' reserve requirements and creating lending schemes for companies, especially SMEs. I'd like to note, and I'd like to repeat that what we saw was that most central banks eased on monetary policy and actually reduced reserve requirements as expected, and they created lending schemes for private companies. There were hardly any interventions in the securities and derivatives markets, reflecting the less developed nature of Africa's financial markets. Yields have dropped, especially in Nigeria, to levels below inflation, and we're yet to record interventions in this space. Some African central banks have chosen to intervene in the FX markets. The interventions reflected that they still see this market as one that requires intervention from time to time, speaking to the emotional connection with foreign exchange markets, rather than allowing the markets to assist in asset allocation. We saw South Africa adjust its repo operations, and he lengthened the tenor of repo operations from overnight to 3 to 6 months. Real estate, because we should ensure we touch on every sector and the asset class that some of the panelists will speak to. Witnessed liquidity pressure as well, especially the commercial segment, which in this case has been intensified due to this pandemic. Lease payments, what we see is most people deferring, in some cases being unable to keep up with lease payments, especially in the hospitality and the retail subsectors, due to the slowdown in footfall predicated by the safety and health concerns. The office and industrial subsectors have also started to face challenges by changes in the way people work and changes in supply chain. What we're having today would have been all of us coming to some hotel or some office to have discussions. Near-term impacts may be offset by tax reliefs or some other government stimulus. Earlier, we had Gbenga speak to government stimulus, and I think a lot of African countries will still need to consider this and how to support these economies, because apart from the tax reliefs, there have been massive dislocations and impact on jobs. I'm sure that the panelists will speak, the eminent panelists today will speak to this a lot more as well. Nigerian financial markets, let's spend some minutes on this as well. where we sit, the exchanges, we can report to you that the number of deals in the Nigerian Treasury bills and normal bills market have declined sharply. I think between Q1 numbers and now, using the FMDQ platform as an example, we've seen a drop in turnover close to 55%. There's been little trading in the non-government sector, and in terms of statistics, all the numbers are down. The OTC FX futures, which the central bank has used as a policy tool to arrest volatility in the FX market, saw a rise in March, and the value of pickup went up. But as central bank interestingly increased the futures rates, there's been a drop in that sector, and hopefully, I'm sure the panelists will speak to that. A situation where the spot market at the moment is miraculously steady, and the futures, the rates for the futures are rising. Probably portend a situation where you have less hedging going on in the system, and then the central bank may have to face that sort of reaction, which could lead to further pressure on the currency. On commodities, the export commodities in Nigeria dropped as the global market demand dwindled, and stock continued to pile up. In some cases, they couldn't even leave the shores of Nigeria. The price of cocoa has fallen. The price of Bonny Light, which is a crude oil blend price, has also dropped by about $20, and has just recently rebounded to levels of about $40 per barrel. Other economies have not fared any better at this time. The equity market in Nigeria has experienced wild swings. There were profit-taking activities at the onset, and which was soon eclipsed by buyers who recognized value in the price. This corrected the stocks, some of these stocks, and April recorded the best month, quite honestly, since 2017. What has been apparent, however, is through the daily ups and downs of the stock market, the shallowness of the market is revealed by maximum price movements, even with only few trades being executed. Foreign transactions have declined from about 70 billion naira in January to about 35 billion naira. While foreign inflow into the stock market reduced from about 23 billion in January to 18 in May, outflows reached a peak of 87 billion in March and have since reduced to 16 billion in May. Year to date, the Nigerian Stock Exchange Prime Index, which is the NSE All Share Index, has dropped by 6%. Despite this pandemic testing the resilience of the Nigerian financial markets and almost bringing them to their knees, the financial markets are still standing, and all the markets are able to operate virtually. And I think to date, since we started, we've not reported any disruption to the digital offerings of both the Nigerian Stock Exchange and the FMDQ platforms. The debt market has seen the issuance of new corporate bonds and commercial papers, especially of prime companies at this time, and is boosting fixed income activity, albeit the primary market side of it. CBN stimulus. The proposition by the central bank recently to stimulate the economy portends good news for the financial markets. From the proposed establishment of Infraco PLC, which will have an uptake of 15 trillion in terms of equity and debt capital, and for various injections into the real sector, sectors of health, manufacturing, agriculture, etc., the involvement of the capital market will definitely be essential. From SMEs having to raise equity in order to expand and to be more efficient in scale, opportunities for the government to raise domestic bonds, private sector participation in infrastructure programs and projects, the vista is actually very encouraging. Sustainability financing, securitization of assets, introduction of alternative debt instruments, derivative products, hybrid asset classes, private capital, etc., should characterize a new landscape as we embark on a new journey for after emerging from this pandemic. We've heard the central bank governors speak to taking control of our economy, taking control of our destiny, and taking control of our future. Such ambition and goals will require coordinated and structured program from government and private sector. Private capital will especially be essential as the government is coming to the realization that no true economic growth can be achieved without private sector participation. And we're talking of private companies here. Some are small, some are medium-sized, and some are large companies. This will introduce the much needed depth in our markets and make aspirations of having a more liquid capital market able to withstand shocks become a reality. With the diversification agenda of the government hopefully becoming a reality, the need to have embarked on foreign exchange reform will be apparent, and our foreign exchange market will truly become market-driven as it ought to be. Ladies and gentlemen, now is the time for all of us to develop ingenious and innovative ways to grow and deepen our financial markets. The conditions thrust upon us have left us with no choice but to make these markets work. As regulators, market organizers, market developers, transaction partners, investors, etc., we all have a part to play, and it is my hope that we rise up to the challenges and opportunities ahead of us and ensure that we work towards building the financial markets capable of turning around the economy and the fortunes of this great country. We must always remember that capital is highly mobile. And when I speak to capital, I'm not speaking to foreign capital alone. I'm speaking to also the capital of Nigerians and of Africans. Capital is highly mobile, so we need to do a lot strategically and tactically to attract it and to retain it. Thank you for the opportunity to be part of this session, and I wish you fruitful deliberations.
Thank you very much, Coco, for that. Highly insightful as expected. Many thanks for your insights. I mean, quite a few takeaways from that, and we look forward to interrogating some of those themes as we move on to the panel conversation. I know that you won't be taking questions, but I just thought maybe if I can just ask one question before you leave us, so to speak. I just want to get your perspective on how you see, I mean, you mentioned something which I thought was very important. You said it's really time to develop new and ingenious ways to make the financial markets work. Now, I just wanted you to, if you like, put on the hat of capital market. You did mention that you're not a market regulator, but more of a organizer, if I want to use the term. How do you see things changing? One theme that I certainly anticipate is that, just as you mentioned at the top of your presentation, that we shouldn't begin to think Africa, Nigeria, we must indeed think global, because the concept of globalization in terms of investing is a real one. So with that in mind, I just wanted to get your thoughts about some of the trends you anticipate could come out of this pandemic moving forward, in terms of how people invest, maybe the type of securities that may be available, the options that investors may have. Just a few thoughts on that before I let you
go. Thank you, Wale. And I think the panelists you have will do a better job, but I'll try. and they'll probably take on from there. When we look at markets, your markets, anywhere you have to set up your markets to attract liquidity, and that liquidity will come on the back of confidence, and confidence will come on the back of governance, structures, products, and all those things. I think Nigeria needs to very quickly appreciate the role capital will play. And as I said earlier, capital of Nigerians. Nigerians today, the world, everybody is exposed. It's technology, there are platforms, there are top practitioners, some of them on this panel, that interface with, anyone you can think of globally. So if I'm an investor in Nigeria, I'm thinking of my wealth and how to protect my capital and grow it. So the value of the foreign exchange will need to be right. The yields I get will need to be right. When I talk about the value, it's not for it to be, it's not that the currency will not depreciate and appreciate, but there are risk management tools to hedge this volatility out so decisions can be taken. Foreign direct investor will look at your country and look at the structure of your step up depreciation for a long period. It could be stable, then overnight you take a big jump up and then you run that step up. So it looks like steps. That's going to be very disturbing for a foreign direct investor who is mindful of protection of capital and for that business to continue to generate. So we need to quickly think of what sort of philosophy we're going to have in Nigeria. What sort of economy do we want to have? And that would define the sort of markets and what we do with our markets. And in positioning these markets, we want them to be better than the market of a competitor. The countries are actually competing for capital, and capital is moving and looking for the best. So for me, I'm going to end by saying the first thing is the philosophy. What do we want with this economy? How do we want to run it? And the government and private sector, once we have that codified, we can then start dealing with strategy, leadership. And then once we have the philosophy, the strategy and the architecture will fall in place. And each time, those of us in our small places, when there's regulation, then you know what that regulation has to be. The capital market regulator and the central bank are the big regulators in that space. They too will align their regulation. For us, we look at market conduct because that is important for liquidity. And we want to ensure that the players in the market, are ensuring we have a market that's got integrity. Our fixings, our indices, and all those things must be independent. And that's some conversation that I believe that Tom, Onome, Ini, and all my other colleagues will speak to. But post-pandemic, and we shouldn't wait, but Nigeria needs to reposition this, what I call the DNA of his economy and the market. We've seen some treaties coming out from the central bank. We're waiting for the SEC, but there has to be some structured, some codification. It's almost going to be like the Bible or the Quran. We have to take them that way, that you will not deviate from this. And nobody, irrespective of who you are, will deviate from this. And that's how to run it. So you can't change that philosophy once the country decides that's the philosophy. I think Nigeria needs to start, and this is an opportunity from this crisis to produce heroes from this crisis and produce a greater country.
Indeed, thank you very much. And on that note, I want to say thank you for sharing your thoughts with us. And I don't know how long you'll be sticking around for, but it was really great to have you as part of this conversation. All right, so we'll be moving on now to the panel conversation. And we're, of course, still staying with the overall theme of today's event, which is the economic landscape and investors' preferences as we move very quickly into that. Starting with Iniebong, who is the Group Executive, Treasury and Financial Institutions at First Bank. Prior to that, he was the bank's treasurer, a position he occupied since 2011. And before joining the First Bank, he was head of Africa Fixed Income and Local Markets Trading at Renaissance Securities. Prior to that as well, he had worked at Citigroup and obviously has had a very distinguished career in financial services here in Nigeria. We also have joining us as part of the panel today is Siri Agbeyi. She is a partner and head of private wealth services at PwC Nigeria. Prior to joining PwC, she worked with the international tax services team of PwC New York, focused on Africa. And she has well over 14 years of experience providing international tax services to multinational companies in various industry sectors, including the entertainment, oil and gas, private equity, telecommunications, retail, and consumer sectors. So clearly very qualified to chime in today's on today's conversation. Also joining the panel today is Onome Komolafe. She's divisional head at the CSCS and ex-chief operating officer at Coronation Merchant Bank. She holds a BSc and MBA from Obafemi Awolowo University. She has worked in different capacities of the payment and settlement system in Nigeria's financial ecosystem. And prior to joining CSCS, as I mentioned, she held the position of chief operating officer at Coronation Merchant Bank, in which capacity she led the operations and technology transformation strategies across the entire organization. Sadly, we will not be having Chiefo Ejiofor as advertised. He's obviously from Fidelity Bank, but unfortunately he's unable to join us today. But we certainly have many other highly qualified people to chime in on this topic. Another panelist today is Adeton Dosumu. She is the head of fixed income, currencies, and treasury at FBN Quest Merchant Bank. She has over 19 years work experience with a focus on various treasury functions, including fixed income securities, asset and liability management, foreign currency trading, and derivatives. And prior to joining FBN Capital in 2013 as the head of fixed income and treasury, she had successfully set up the fixed income trading desk as a major income generation unit of the market division of the organization. So, Adeton, many thanks for joining us. And last but certainly not least, we have Abiola Adekoya. She is a wealth expert and the ex-chief executive officer at RMB Securities. So she is a stockbroker. So very useful insight and perspective to the conversation today. She's had incredible experience in the capital markets. Prior to her involvement at RMB Securities, she has been involved in equities trading, capital markets, trading systems, and she has strong business development skills in financial services with leading financial service firms in Nigeria. She is also a career advisor and mentor. So on that note, I want to move on to have our panelists perhaps switch on their videos now and join the discussion. And I'd like to start with Ini. Ini, thank you so much for joining us today. Obviously, you heard Coco speak, and so maybe I'll just allow you to give us your opening thoughts about the theme of today's program and how you see investor preferences changing, especially from your perspective in the banking sector.
Thank you, Wally, and good morning, everyone. Thank you for having me on this webinar. I must admit it's very thoughtful and insightful on the part of the ZCRES group. I think the keynote speaker, Coco, made some very poignant observations in terms of what has happened with respect to the COVID pandemic and impact on global financial markets and Nigerian markets in particular. I think also, for me, the key takeaway is really the question he posed around what kind of market do we want? What kind of financial market architecture do we want as a country? Because if you step back and you followed Nigerian financial markets, as many of us have, my colleagues on the panel have, for you go back maybe 15, 20 years. He used a phrase which was, we have step changes. And if you look at FX, we have step changes in devaluation. So it suggests that we tend to have many knee-jerk reactions to various events. What is certain in markets, there'll be ups and downs. Markets are never stable. There will always be volatility on account of various global macroeconomic conditions. But what is important is the architecture you build around your market that allows you to navigate that. And I think once again, we're at an inflection point where we have an opportunity. And when I say we, I mean both the regulators, market practitioners, institutions, investors, to reset our financial market architecture, to make a...
I'm so sorry, Ini. My apologies to Botin. We are getting some feedback from some of the participants saying that they are struggling a bit to hear you. So if you can just project a little bit, maybe it will help. I can hear you clearly, but it does appear that some people are struggling. So please go ahead.
Okay, I hope that's better.
I think so, yes.
Limitations with technology.
Please go ahead,
as we
thank
move
you.
into this new COVID era where we have to do these things virtually. So what I was basically saying, I think we're at an inflection point, and I think it's another opportunity for us to reset our market architecture. Interestingly, also, we tend to have these opportunities around periods of crisis. We have taken some steps forward in our view, because if you step back and think of some of the core changes that we've made in the last, I would say, 10 to 15 years, they've been significant, where we've opened up our markets to foreign capital. We were largely closed up until the mid-2000s. We've internationalized our markets, but we always struggle with this tension between regulation and liberalization, as do most developing economies. And it's getting that balance right that is the key. And increasingly in the era of globalization, I think the balance must tilt towards more liberalization and less control. So very thought-provoking from Coco, and I truly do believe this is another inflection point that we should seize, albeit led from the regulators. Thank you.
Right. But sorry, if I can stay with you for a second, and if you can just speak briefly to this point on investor preferences and how you potentially see things changing in terms of comparing what investors would like and the offering that banks like First Bank are able to provide right now to investors. So can you just share your perspective on how you see things evolving?
Well, the good thing with development of financial markets, it increases the breadth and array of products that are available, right? If you look at traditionally what the banks offer, we typically offer deposits, which really are a function of where the current monetary policy frame we operate within. Today, the bias, as pushed by the regulator, is for a lower interest rate regime. So as such, we've seen yields on both domestic securities as well as money market instruments drop quite dramatically, so much so that we're sub-inflation, right? So if inflation is cresting almost 13%, we have deposit rates that are in the single digits, clearly a big disconnect. So what we're seeing is the rise again of alternative investments. We are seeing the larger corporates come back to the commercial paper market. So we see other almost direct corporates raising debt in their own right, and then people are accessing that to get some higher return. We're seeing investors look towards other asset classes. So we've seen capital market operators issue various kinds of bonds, fixed income, infrastructure, special kind of instruments that are available that offer incremental yield. So there will always be these products, and they are being marketed quite aggressively. The real question really is, what is the view around where the direction of rates and the direction or sustainability of current policy in the face of, you know, the global or macroeconomic conditions we face. Certainly, central bank has a lot to deal with on its plate, and it's really a question of what is your risk horizon in terms of timeline, if you believe this, and what is your appetite for risk. And as the markets develop, we find that the investing public becomes more able to embrace risk and go on for higher return instruments outside of traditional bank-based deposits.
Right. Thank you very much. If I can come to Tone now. Tone, thank you again for joining us. And Ini mentioned the commercial paper market, perhaps taking a new life under the current market conditions. And I would like to maybe start by mentioning that and having you also speak to how investor preferences are changing vis-a-vis the products that are available. He had clearly mentioned that given the dynamics we're seeing with government securities, yields, and inflation, there is certainly a huge appetite for real returns, because clearly you can't get that by simply investing in many of those government instruments today. So I wonder if perhaps that is giving us an opportunity to really explore new products that maybe have always been there but may now begin to become more popular. Just your perspective on this.
Okay, thank you for having me. Yes, you're right. So right now you have banks that are, because of the LDR policy of the CBN, where it says that 65% of your deposits was being risk assets. So you have banks that are scrambling to generate risk assets to meet that regulatory requirement. Now that means they will be out there looking for good credits to take on their books. And once they do that, they will also be looking to de-risk their balance sheet. So it means, like Ini had said earlier on, traditional deposits will no longer be a play, because I'm looking at managing two ratios, my CR and my LDR. So it means I'm trying to get funding off my balance sheet. So you have innovative products like notes, different instruments that banks are using to ensure that they manage those two ratios. Yes, you have commercial papers. Of course, then you have even people dabbling into the capital market now that yields are low. You have the blue chip company to issue bonds and all that. But also, you also have different ways by which you are trying to give a higher return onto your clients. So you're using you're trying to, like I said earlier on, de-risk your balance sheet by creating innovative products that people can invest in, apart from the traditional banking products.
Right.
Now, that brings us also to,
Yeah, sorry. I think you are hitting on a very important point. So you are saying there's some product development happening in the banks, and I wanted to know what the end game is here. Clearly, a big requirement of investors today is yields, higher yields. They don't want to get those negative real interest rates. So can you explain, maybe give us a little more insight into, without giving away trade secrets, so to speak, a little insight into how you are creating these products rather, and the type of yields we can anticipate from those vis-a-vis the risks that people will be taking.
Let me expatiate on what I just said. Before the banks try to create those products, they have to manage their own regulatory issues first. So if I have a 65% LDR and I'm trying to grow my risk assets, it's when I've gone over and above that 65 that I'll now look to sell down some of those assets, maybe to my customers. So it's more, yes, everybody's saying they're looking for high yielding assets. And truly, the onus is basically, a normal excuse you've had over the years is, the federal government is crowding out the real sector. that's the usual song that the banks sing, I mean, the past 3, 4, 5 years, because you had interest rates at double digits and it's risk-free. Now that that is no longer the case, we have to sit down and look at good credits to invest in, good credits to take on our books. Now, when we meet that ratio, I will now see how I can pass on some of that risk to my customers. So that's when, high risk means high returns, right? So if you want high returns, that means you must be willing to take on more risk. But as banks, we need to meet those regulatory ratios first before we can think of risk participation with customers. So for now, they still, unfortunately, have to deal with those low yielding environment, because you're, even if you have a bond, if you have a bond or a CP that's issued now, it's going to be tied to a risk-free return plus 200 or 300 basis points, depending on what your risk rating is. So you are still going to definitely be getting a single digit, though inflation is double. So right. It's sorry.
No, that's fine. Thank you. I think that was very useful to understand the dynamics of how the banks are thinking about creating these products and the end game. Before I move on to the next speaker, I just wanted to alert everyone to a poll that we are taking during this session. If you'll find on the panel of your screen poll, so please click on that and participate in that poll. There are 3 questions there, and it would be great to get thoughts of the panelists and everyone else who is on the call. So the 3 questions are: 1, what is most important to you when choosing an investment option? Now, we have well over 800 people on the session today. It would be great to hear from everyone if possible, and we can compare the views as a hopefully useful sample. The second question is, your investment may provide a hedge for your capital. Which of these do you consider the most important? Is it FX hedging, inflation, or loss or bad spending habits? So and the third question is, what are the important things you look out for when choosing a money manager? Proven track record, regulatory compliance status, reporting and transparency, or is it all of the above? So please, we'll really appreciate if everyone can participate in that. I can see many people are already answering the questions. Thank you so much as you do that. All right, I want to now go on to Onome to hear from another panelist. Onome, it's great to have you here. Thank you so much for joining us. So let us hear your thoughts on product development. So clearly, it's perhaps the way to go given the current market conditions. And I just wanted to hear your thoughts about product development and service delivery, how you see that evolving in terms of investment management and corporate banking. So what kind of new ideas do you anticipate that we'll begin to see? And as you speak to that, I'll really appreciate if you can also speak to the global framework for all of that, because as Coco mentioned earlier, and I think I mentioned as well, we're really living in an age where investors are not thinking about investing in Nigeria, they're thinking about investing, period, wherever they can get the yields in line with their return profile, risk profile. So please, over to you, Onome, on that.
Yes. Now, when you talk about product development today, it's very important that we consider the use of technology as very key. We've been at lockdown for about 3 to 4 months now, and nobody has been able to go anywhere now. So whatever product you're putting out in the market, it's important that you leverage on technology. That's obvious. But how do you leverage on technology? I mean, everybody says that because nobody wants to interact physically with anybody. You need to also consider how you would have some level of interface API interfaces with whoever you're dealing with. Electronic channels are very important. Another key thing you have to look at in these times, you need to be able to segment your clients in whatever you're doing. In terms of you want to segment them based on gender, based on age, and people say that data is the new gold. You need to know who you are dealing with. That segmentation is very important. You need to be able to segment the guys that are going to be on LinkedIn separately from the people that are going to be on Facebook. I mean, people say that there's a certain age bracket that would remain on Facebook, and then there's a certain age bracket that would remain on Instagram, for instance. So you need to be able to achieve that segmentation. Now, what's the fallout of this segmentation is for you to be able to do a product differentiation so that you know who you are targeting. And even in that product differentiation, you need to also be able to do a communication differentiation in terms of how you communicate the sales of your products, because like I said before now, different people are on different platforms. So if you are trying to target a kind of customer, you need to know. And talking about CSCS where I work, we've always thought about this. So even from the customer onboarding onto getting feedback from clients, we've always had that as something that is a self-service platform, is technology driven, because that's the way to go. I've been out of the office now for about 4 months, and there's no difference in terms of the service delivery. So you need to be able to leverage on that. Now, in terms of globalization, the truth of it is that before now, it's easy for you to not be concerned about your standards, because it was really difficult to compare globally. But today we know that that's very easy. A lot of people are today on this conversation with us, and they're not even in Nigeria, and they're listening to us. So you need to be able to give people things that have global standards. It's not just something that is local to Nigeria, or is acceptable to Nigeria. And that means that you need to have some level of partnerships across different geographies to be able to meet up. When we talk about global citizenship, global standards, these partnerships are key, because that's the only way you'll be able to meet up with these standards as they come. Another thing that is very critical
we are struggling to hear you, sadly. I think it must be your internet connection. If you can hear me, we are struggling to hear you. Okay. Onome, if you can hear me, we are struggling to hear you.
With the service provider.
Okay, it's better now. Oh, okay. Have we lost you? Are you still there? Okay, Onome, we struggled to hear most of what you said, sadly. I think there was a problem with your internet connection at a point. Hopefully we can have you back at some point. But let me go to a Siri. Okay, Onome, are you there? Okay, Onome, hopefully we can come back to you in a bit. Siri, and in a sense, I want to pose a similar question to you in terms of, especially given your perspective and being in a PwC, a global institution. One of the trends that I certainly am anticipating to become a thing moving forward now is just, like I mentioned, people who simply want to invest, period. It's not a case of investing in Nigeria or Ghana or the US. I think technology is enabling people to simply have those options. And I think that the more investment service providers are able to make this possible for investors, then they certainly would win. But maybe you can speak to the trends that you're anticipating, and then also, as you do that, speak to the regulatory challenges that could, if you like, limit that trend from really taking off.
Thank you, Wally. So I think looking at it from the investor's perspective, which is what I pretty much deal with on a regular basis, it's similar to what you've just mentioned about investors looking to invest in other locations and not necessarily Nigeria, Nigeria inclusive anyway. And I think that speaks largely to the point around diversification. One of the key
weaknesses we see now is just having your funds sitting in one location and in one currency, especially one that's prone to exchange currency fluctuations, is disadvantageous. And so the opportunity for then looking towards other markets that have stronger currencies exists. And that's a request that we're seeing live, real time. That's what people are asking for. Liquidity definitely is an issue, and I'm sure that also would impact on the banks as well, with a lot of decline in repayments of debt and a lot more investors looking to hold on to their incomes. In some cases, we've even seen that they're taking out monies or invested funds from assets which they consider now risky. But what we're also seeing is with the lower valuation or devaluation of some assets, that increases the propensity for investors to increase in those low valued assets. So it's really a time now for them to begin to look into assets that are devalued that they can invest in, taking advantage of the market at a low time now, and arching or making out capital gains that could significantly come out from those. PwC usually conducts surveys, and in 2018, we conducted a survey for family businesses, and the results were quite revealing. 63% of family businesses would consider private equity as a source of funding. The reason for private equity is one I think we probably should consider here.
Sorry, we lost you for a second there when you were giving the results of your survey. Can you just take that again, please?
Yeah, so I'll take it again. So we usually conduct family business surveys, and one of the reasons we do that is because we consider that a very niche area for growth in Nigeria, especially being that it's also a custodian for most of the SMEs that contributes over 50% of the GDP of the country and about 80% of our workforce. When looking at financing, different sources of finance are identified as areas of growth for them. Private equity being one of them, and banking credit also being another. But then you'd find private equity far outweighs at 63% compared to about 40% when it comes to banking finance. When you compare that to the global average, there's a huge disparity. Globally, it's a flip. So there's a lot more of family businesses leaning towards banking finance as opposed to private equity. Why? Private equity players are considered sharks for the most part, even though they bring in some additional intellect to the business. But then I think the markets are more mature to the extent that there's a lot more dependence on established or accumulated knowledge residents in those markets, which may be lacking in Nigeria. But again, looking at the results, what it then means is there's an opportunity for other asset managers to begin to play in this space, given the appetite for businesses to lean towards private equity. And when we looked at, I think it was the Africa PE and Venture Capital Association that had considered deals between 2012 and 2017, and found that 32% of the deals during the period were all sitting in Nigeria. So Nigeria is rife for those investments, and Nigeria definitely would attract more of those. When we looked at assets under management as well, the projection for PwC at the time is that by 2020, we would have about 1 million, over 1,000 billion, in Nigeria, assets under management. But with COVID now, that's something that's
$1 billion naira or $1 billion.
$1,000 billion by 2020. $1,000 billion by 2020 would be assets under management.
Okay.
Under management, up from about 293 billion in 2008.
That's $1 trillion.
That represented, yes, $1 trillion. That represented an annual growth rate. Yes, dollars, not naira, dollars. that represented an annual growth rate of 9.6%. Now with COVID, those projections are likely to drop in the interim, but I think they would still pick up. The reason I'm giving this surveys is there is a market still, there are opportunities still, there are investors who are still looking to invest in these markets, and there are private equity funds and banks as well that can take advantage of these opportunities depending on the products that they issue out and how they issue them, but also dependent on the customer experience that's delivered. And I think Onome tried to speak to some of those as well, especially in this age of digitization. So for me, I do think that, given some of the requests that we're seeing from investors around diversification and trying to spread their portfolios over a lot more jurisdictions to stabilize their growth rate, it opens up a new space of discussion for financial players, financial market players. And I think that there is still some growth projections that we can expect once we're able to pass that interim phase of decline.
Thank you. Thank you for the insight. All right. Just before we move on, I just wanted to remind everyone again about the poll that I encourage everyone to participate in. We'll be sharing the results of the poll later on. So please, if you haven't shared your thoughts on that, please do so. I can see we have well over 70% of participants already sharing their thoughts. So thank you very much as you do that. And okay, so let me go to Biola right now. So Biola, I'm going to ask you a very simple question. Apart from you just chiming in to everything that has been discussed so far by all the other panelists, I want you to wear the heart of an investor. So more like playing that role right now. What do they want? What's your perspective, given all that has happened over the last several months? Earlier, Coco mentioned a massive dislocation and of the economy and the impact it has had on jobs and incomes. But on the flip side, he has also talked about the fact that this is a time where we must innovate. And because of the peculiar situation in Nigeria, where we're having negative interest rates, I think many people will be looking at alternative investment options, locally, globally, wherever they may come. So, your thoughts?
So thank you very much, Wale. And I would like to first of all start by saying thank you to Zimvest. This is the most diversified panel I think I've been on. A lot of women here. Well done to Dio. Clearly pro women. So I'm very happy to see that. I think one of the key things that investors are concerned with in this era, particularly what this pandemic has shown, is that they need to be more diversified, which Esiri has already mentioned. And that's one of the things that, has really been thrown up, because again, a lot of investors were focused on one product, and that has obviously shown not to work, particularly when the pandemic, like what we are seeing now, happens. The other thing that we have also seen is that there's a strong illiquidity in the system. So emergency funds are the buzzword has been thrown around, emergency funds. And people realize they're asset rich, but cash poor. And that's something, again, that has come through for a lot of investors. So I have a lot of assets. But when it comes down to actually converting my assets to cash in an environment where no one is buying assets, then I'm cash poor. And that's something that has been a recurrent theme. And also, finally, it's also the fact of the lower returns, market that we're seeing generally has already been, highlighted by all the panelists here and Coco, that, it's low interest rates, both in the treasury bills, fixed income, generally low interest rates. And again, what we have seen because of those three factors is that investors have moved to non-traditional asset classes. And, the T-bills, the stock market, the property market, while they still pretend some value, the reality is that more investors are asking themselves, well, I can't really sort of trust these assets. Not that I can't trust them, but the returns are not as great as I would want them to be. So the question is, what can I do? Now, what I'm seeing in the market, I did a survey recently, and about 60% of the people in that survey had never invested in the Nigerian stock market. Now, the demographics for this survey were probably, between the mid-30s and the the 20s, the mid-20s and the mid-30s, which are really where the investment class is. Now, the reality is that we're focusing a lot of our attention on the, would I say, slightly more aging population, which is a 40 and above. But the millennials, the mid-20s and the mid-30s, are really focusing on, they have a more risk appetite, and that's where they're focusing on. Now, I would say...
So sorry, Biola,
yes.
I need to, I won't use the word challenge you on that point, but try to get your thoughts on why that is happening. Because, I mean, obviously you've been in the market for a while. You know, the last 10 years in particular have not been great for equities in general, especially since 2007. I think many people are so badly burnt that they probably have not come back. Do you get the sense that it's going to take perhaps opening up the choice to other markets to really get these people back in the markets?
So I think I'm going to answer that question by telling you that there is capital in that sector. I think what the question should, what I would address is really, where is the capital going to? Okay, because there is capital. Those people do have money.
Sure, I have no doubt. I agree with you.
And
my point is that if since we know that the capital is there, the potential investment funds can flow from that demographic, is it going to take them perhaps being given a broader choice of markets or assets that they can choose from? Because I just get the sense that when they look at the track record of the stock market, they're just not, they're not enthused at all.
So I think the answer to that is these same investors are investing in, they're doing FX trading. These same investors are doing agribusiness. These same investors are doing, they're investing in global markets. So the reality, it is not the lack of interest, the lack of products. And one of the things I am seeing is that our products are not well democratized for that market. So our products are very wholesale in nature. So as Siri mentioned, raising capital, family office, private equity, it is not democratized. Now, that is what the agribusiness fund has latched onto, and that's why they're so successful. They have democratized what used to be a very niche product. It was only for a few. Now you're also seeing venture capital business, organizations popping up that are allowing for democratization of, investing in venture capital. So it is no longer about the few select people that hear about a good deal. Now, venture capital, little hubs are coming up where there's a deal that comes up and you can get 1 million in little small pieces and bunch it up into a lot and invest in. Now, that is what this market is looking for. So I think what I would say is the opportunity is there. The issue is, how do we need to democratize that opportunity? How do we make it accessible to them? We need to now, again, the other part is derivatives is something that is becoming very popular. In Nigeria, we are just at the cusp of that. But again, it is not democratized. It is not open to that mass market. Now, remember, Coco mentioned one thing that I loved a lot. He said, capital is highly mobile, strategically to attract investors. And for me, that is key. It is highly mobile and it is there. So we need to make sure that we put in place leveraging technology, as Onome mentioned, and also bringing out the right kind of products that would excite the market. So, you mentioned the stock exchange. Yes, we now have securities lending. I am very grateful. But again, we need to start asking as financial operators, how do we ensure that securities lending can be more accessible to the investing public? So, and that takes work between the banks and the stockbrokers. The stockbrokers cannot just do it on their own because they need capital. So are the banks willing to back that capital? How do we allow a straight-through process where if I, as an investor, take a shot in the market, how does that translate, hit my bank account immediately? How does the margin, those things need to be in place. Now, till we get a system that allows that, these investors are going to continue to put their money in the trading, in the FX market, in the commodities market where, they're trading gold, and they do put money there. Those agribusiness ventures, they raise minimum, I kid you not, in the last, I work with a company, and in the last, 3 agribusiness transactions, they raised about 1 billion naira. And this is done in like 3 days. So you can imagine, and this is the one I know. So you can imagine if in 3 days...
Sorry to let you go on that point. And we actually need to begin to round up so that we can open this to the audience to ask questions. But I wanted you to explain a little more about that example you just gave. So You said three funds have been able to raise about ₦1 billion. Can you just give us a sense of your knowledge of the investor base? What type of people, what type of income levels are we talking about? Is this HNIs, individuals,
Okay.
institutions?
So, you know, I'm a wealth advisor, and for my wealth advisory business, I have what I call the Henrys, so the high earners but not yet rich, and we have many of them, not rich yet, and we have many of them in Nigeria, right? We have people that are earning a lot of money who still stay at home with mom and dad, whose bills are quite capped, and they're really the guys that are really making things happen. So you see them a lot in the tech businesses, you see them a lot, you know, they're now being hired by a lot of the consulting firms, and they're earning quite decent money. And, you know, they're not afraid to take risk. And this is the thing, they are risk takers. They are keen to take risk and push the risk boundaries. They're not afraid anymore because they're in their 30s, 25, 30s, meaning that they have a lot more capital.
Does that make the majority of the investors? Are those the majority of the investors?
They are actually the majority.
So it's still really high earners, so not necessarily mass market oriented products.
I would call them mass affluent, but you see, the point is the mass affluent, you know, can squeeze. If I can guarantee a mass affluent person a decent return, they will squeeze out ₦1 million for me. That is true. They will squeeze out. They would inconvenience themselves and squeeze out 1 million. Now, if I cannot guarantee a decent return, I'm offering 3%. They will be like, why should I bother myself? So the question is, we can squeeze out 1 million, and we can squeeze out 5 million, you know, 5 million, 10 million, but we are not, because we think, well, it doesn't really matter. But think about it. In 2 days, these people can bring about 500 million naira in 2 days. And I'm sure, you know, you would probably see, and this is just one pipeline that I'm aware of. I don't have insight into other pipelines. I don't have insight into other, you know, people's books, but this is just one I'm aware of, and this is what they've done so far. And I think it's something that is definitely, you know, we need to consider as financial practitioners in the market.
It's certainly something to learn from. I mean, if people are being that successful, like you mentioned, in 3 days, they're able to raise that kind of money under the current market conditions. I think some of the investment banking professionals on this call should speak to you as well to hear more about how that's working out. Okay, I would like to take this to the audience, but before that, I want to come back to Ini very briefly, because my sense is that the banks really have a big challenge on their hands. I mean, I get the sense that as an investment is perhaps the last thing anyone wants to do right now, given the yields in that space. And so I do get the sense that the banks need to be a lot more innovative in terms of providing something that offers a reasonable return to investors, and of course, simply meet their needs. Obviously, there is the risk-return trade-off always. But changes dissipate this post-pandemic world from the banks.
Okay, thanks. And I hope it's clear enough.
Yes, much better.
Well, you're right. These are challenging times, but the way we see it, it's clearly, you know, traditional ways of, look, to traditional banking models, we take deposits and lend money, and you live off the spread. But as markets develop, and this is empirical, as financial markets develop, as economies develop, interest rates fall, because the central banks, regulators get a better handle on inflation, which is the core mandate of the central bank. You need to contain inflation. And as inflation comes down, your interest rates come down, right? So that model where banks rely traditionally on net interest income has to change. And we're beginning to see that here, though we are not yet at that inflection point where Nigeria fundamentally becomes a low interest rate environment. I do not believe we are, because we still have double-digit inflation. So
I agree with you.
The monetary policy environment we face today, which has been engendered by the central bank's policies, suggests there's a low interest rate. So what do? As banks, we've had to pivot. And I think my colleagues have mentioned a few of the constraints we have. We've got a new loan to deposit ratio, which in its own wisdom, the government or the central bank is trying to engender credit growth to the economy, perhaps rightly so. But one of the things I mentioned, you cannot legislate lending, certainly not in an environment which looks weak. Otherwise, we're just potentially throwing money out the door, because ultimately those loans will go bad. So yes, we'll see rates on the asset side, on the lending side, come down, obviously so, as banks struggle to lend to the obligors that everybody wants, right? So we are under that compression. So we've had to pivot more towards providing service, as well as all the efforts we're making around in the digital space.
But sorry, if I can just interject a little bit. I think I picked something from what Tom mentioned earlier. It does sound like there is now a move within, in terms of developing products in the banking sector where you have your borrower, and because you have, if I can use this as an example, a AAA borrower who wants 10 billion, you are able to develop a deposit in quote product for that 10 billion, which can give hopefully a relatively decent return. So in a sense, you're kind of matching your assets with your liabilities as you go along. And that way, potentially, you can give higher returns. Does that sound like a model that we're seeing now? As opposed to having that whole general cost of fund concept, which we know has been the case in banks for many times.
Yeah, you're right. You're seeing the model, but the reality here is that the banks are being disintermediated because the AAA borrower doesn't need a bank. The AAA borrower gets a bank to do an advisory for him, and he issues his commercial paper, right? And there's one of the comments here where someone's talking about that. And if you look at it, you would have seen most of the blue chip names we know that traditionally we've known in this country. Everybody has come out with some form of commercial paper program or another where they're reaching investors directly. So so there's really some degree of disintermediation happening there. So the way the banks are responding is around providing service offerings to meet the needs of those corporates. So again, the whole push for digital is critical. And that's why you're seeing the investments that banks like ours are making in that space to provide the platforms that enable those business do things. So it then doesn't so much become a net interest margin play, but more of a service offering where you can charge some fees. And that really is the direction we will go. And as the economy grows, those rates come down. That's what you have to do, evolve into a service model, especially in the digital space. And we've seen that through this COVID period. And that's how, yes, in the last 3-4 months, when most of us have been cooped up at home, we've been able to keep the economy going.
Well, we look forward to more ingenuity from the banks. Before I go to the audience for questions, I want to hear Dayo, if you can say he's our chief host here. Adedayo Amzat, CEO of Z Press Group. Dayo obviously has huge experience in financial markets as well. So Dayo, let's hear your contribution to this conversation.
Thank you, Wale, and thank you everyone for clocking into this program. Well, everyone has spoken very beautifully. I mean, Adeola has very strong points, and she did a very good job of speaking as a client. And it's interesting to see the mind shift, all right? A decade ago, the larger market does not know what they call treasury bill. A decade ago. Then all of a sudden, it became the only asset class in Nigeria. Only asset class. Asset managers became irrelevant as everyone could immediately invest directly in treasury bill programs. The government latched onto that too, came up with savings programs. So it became a mess. Well, now we are seeing the reversal of all of this, and it's causing a big dislocation, just like Ini and everyone has rightly said. It's made a mess of whatever strategic plans that we've been used to as banks or as asset managers, and even as investors. My own contribution is just a word of caution, right? It's not the first time that we've seen this kind of dislocation where you would have long-term inflation expectation way higher than short-term return rates. And it's a problem. It's a stress point for investors. I mean, it's a double whammy period. You are fighting to protect your purchasing power. You are losing money on a lot of things. So you want at least your investment base to sort of mitigate all of that for you. And then there's a rush to all alternatives, no matter how sweet they sound. There's a lot of stories around what happened in the 90s in Nigeria, where you had like an explosion of alternative asset providers, so-called finance houses, coming up with beautiful products. And in less than 6 months to 1 year, all of that money got lost. And people had hypertension, people died, people lost their pensions. So the caution here is we should see this as a bad year, not a bad life. It's okay to have 1 year of slight underperformance in your portfolio. It's okay to have that. as long as capital is protected. What you want to look at is, okay, what does the trend look like for the next decade? Now we see an explosion of platforms. We don't even know the guys behind those platforms. You see a lot of online adverts. Come and invest in one farm in Kanuri, and you start to ask yourself, on what authority is this person asking for investors' money? The person is taking advantage of desperation of investors right now. People are used to treasury bills at 22% yield. Now the same treasury bills is 1%, 0.5%. So it's understandable that they're under stress, which is why we as a group of, the market experts, the regulated industry, the advisors, we have to come together, and where we are asking for new products, we must sound that trumpet of caution to everyone. Not all that glitters is gold, and that's reality. There's no way to guarantee 15 to 20% return in a market where risk rate is 2%, in a market where GDP is not growing, in a market of negative productivity. Anyone promising those kind of returns, you have to look at it with like a microscope. What exactly? Who exactly is it? And I think that's my own contribution.
No, that's an excellent contribution. Thank you so much. Very useful. Now, I want to go to the audience, and we are pressed for time, as is often the case here. So what I'll do is I'll just take those who have raised up their hands first, and then I know that we have some people who have submitted questions. I want to appeal to everyone. Two things. First of all, as you are sharing your thoughts about the conversation on this platform, please use the hashtag ZimVestConversations. That's ZimVestConversations. So a reminder for you. And then please, as you ask your questions, please be very concise. Go straight to the point, please, so that we can take more questions. And then, as much as possible, please let us know who you're directing your question to. So I'll start by allowing Gbenga Adigun to speak. So Gbenga, over to you. If you can unmute yourself. Yes, Gbenga, are you there?
Maybe, Wally, maybe we should take somebody else.
Okay, all right. So maybe we'll move on to the next person. We have Adeola Ajibade. So Adeola Ajibade, please unmute yourself and ask your question. Adeola, are you there? All right, we're struggling with those who have raised up their hands. We have Grace Onochie. Grace Onochie, if you are there, please unmute and ask your question. We seem to be struggling with that now. Okay, let me go to those who have submitted questions on the platform. Hopefully we can get some of these people to unmute as we move on. We have a ton of questions here, and I'll just take a couple. This wasn't directed to anyone specifically, but maybe professionals in the treasury business and the financial markets can chime in here. Do you think that investing in bonds is the best way to tap into alternative finance for states and companies, given that the cost of borrowing is low? So I think that's a question to those who understand investing in those assets, states and companies. I imagine that the answer is perhaps yes, because we've talked about commercial papers here, but Ini or Tom, would you like to comment on that one? Do you think that investing in bonds, now we're talking about state and corporate bonds, is the best way to tap into alternative finance or alternative investment opportunities?
Yes, I mean, this is the best time to go into the market to borrow because yields are currently very low. So for state governments, the good ones, the ones that have sustainable IGRs, just one has come into the market this year, but I know that there are a few more will be coming before the end of the year, especially now that the the FAC allocation they get has been going down on a consistent basis due to the reduction in crude oil prices. So you see quite a bit of them coming into the market before the end of the year. Also for the companies, the ones that are blue chip, the ones that are A-rated, this is the best time for them to come into the market because they have the opportunity to lock in for a longer period, to lock those yields in for a longer period, because they will go at least minimum of 5 to 10 years, depending on what their preference is. And yeah, so this is the best time to do it is now. Yes.
All right. So the environment is perfect for that. Thank you. We have a question about investing in gold. So how can one invest in gold? There is a question there about whether or not I can get direct exposure into gold. But I think at the end of the day, people are looking for the exposure because of the return. And this speaks to the point that, as I mentioned quite a few times on this in this session, that people are looking to just get to invest. Period. They don't care where those investments are domiciled. They just want to get invested. So maybe Biola or anyone else on the panel may want to speak to the potential of investing in gold. You need to unmute, Biola. We can't hear you. We still cannot hear you. Okay, we can hear you now. Oops, we lost you again.
I've answered the question. I said to invest in gold, the NSE has a gold ETF. I think it's one of the products that we don't take advantage of as investors, So I think I would encourage investors to look at it. And I did look at the trading patterns. It traded quite a bit during this period, and I think more people should definitely look at it because gold was up. So we do have a gold ETF listed on the Nigerian Stock Exchange.
And people can simply speak to stockbrokers to get.
Absolutely, it's trading. It trades like normal. You can buy, you can sell. I think please, right. And it's gold. It's to the gold in the JSC Stock Exchange. So I think you should definitely look at that and we should invest in it.
All right. Awesome. I think those who raised their hands earlier have now unmuted. So maybe I can start with Adeola. Please, can you ask your question? Oops, you've muted yourself again.
Wale, can we take people's hands from the bottom? Some of these hands have been there for so long. So let's try freshly raised hands.
Okay. Okay, now I'm struggling to know which one is fresh and which is okay. I can see the list now. Okay, let's try some others. Caleb, do we have Caleb? Caleb, do you have a question, please? Go ahead. We can't hear you, Caleb. Please, can you speak into the mic? I know you've unmuted, but we cannot hear you. Unfortunately, we cannot hear you, Caleb. I don't know why. Okay, let me take another one. Share Dosumu. Can we have Share Dosumu? If you can unmute yourself, please. Hello, Share Dosumu, please. Wow, we're really struggling with the mics today for some reason. I was really hoping we can hear from people directly. Let me try another one. We have Chioma Abu. Chioma Abu, can you just unmute yourself and ask your question? All right, we're still struggling. Okay, let me take a few more questions from those that were placed on the platform. Okay, I think this is a very general question, maybe just to provide some insights for what is possible. The question is, my question borders around low yields versus inflation. What other investment outlets are out there? So, as I mentioned earlier, people are looking for yields. Maybe Onome, Biola, you may want to speak to potentially what else people could invest in. I thought it was quite interesting. What you said about the agri opportunities for those who are raising capital there. But maybe I can start with you, Onome. We struggled to hear you. If you are there, please, can you just unmute yourself and make a contribution? Onome, can you hear me? You still need to unmute. Okay,
Yeah.
please
Can
go
you hear
ahead.
me now?
Yes.
Okay, sorry, I didn't get the question. I was thrown out for a bit.
Oh, I see. The question essentially is, apart from, if I can paraphrase, apart from fixed income, I'm looking for yields in this market right now. Where can I go? What else is out there that can give me?
Okay, that can give you some yield. I think someone mentioned about the gold ETF, which is traded on the stock exchange. That's an option that you can take today. I know also Adeola mentioned about the Greek investment options. Even though I would be careful around that because I'm not too sure around how regulated
I think
that is in.
Dio also.
Yes, Dio also said something around the regulation. So in terms of where to put your money today as a very safe, I would say, even though that may not sound in today's world might not sound practical, but I will say to you that the capital market today is still a good place to be. The reason being that you might look at it in the short term and say, oh, the yields are not good. But I will say to you that this is actually the best time to put your money in the capital markets. And there was some discussion. Can you hear me?
Yes, I do. I wanted to challenge you on that. I tend to do that quite often. So when you say the capital market is the best, what I think about is, when you invest in capital market, you invest in companies. So if the companies are doing well, then yes, you can expect that your investment will do well.
Yes.
But if the companies are struggling, then why should, because I imagine a lot of businesses are struggling today. Why is the capital market still the best place to put in your money?
So what you should do is find out. So in today's world, COVID-19 has happened, but the truth is a lot of companies, believe it or not, have benefited from COVID-19. And so when you want to make this investment, you want to find out who are the losers and the gainers in today's world. And I can tell you that there are winners in today's world. There are a lot of money being made by certain companies. So I think also it's around the knowledge. I mean, I really liked when Adeola was speaking as to why people, the millennials are not in capital markets. And I will say to you that the reason why they're not there is that the knowledge and the ability to acquire the knowledge is not on social media. And that's where they are. And it's not talking down to them. It's just saying that that's the reality of the communication methods that we need to change, even from the capital markets. We need to change that. Nobody is going to take up some textbooks or some very long book to read about capital market investment. You need to put out those tidbits in the social media and tell them, oh, the capital market is down, but if you invest in the health sector today, you will make a lot of money. If you invest in food, in FMCGs, you will make a lot of money. So we need to put out that. And then we need to make it easier for them to make those investments. You need to be able to get on your mobile phone and invest in the capital market without any hindrance. Then we need to also ensure that there's some kind of connection between the banking sector and the capital market. I need to get into my internet banking platform, and from my internet banking platform, make a decision about an investment in the capital market and make it happen immediately without having to interface with anybody. That has to happen. So today, I think the capital market is the best. But why is that information not out there? Because the channels to provide that information, we have just refused to leave our stock-up ways and move on to the new reality of today's world. So I still
believe
the capital market is ready.
Before I round up this panel conversation, because we are running over now, one of the people I tried to raise his hands, I think very smartly went to the chat section. So I will just allow us to take this question, and then unfortunately I will have to round up. I'm so sorry that we couldn't get more people to ask questions. But the question is from Shahed Dosuman. He says, thank you. Industries in Nigeria have enjoyed some, quote, comparative advantages in this COVID-19 era. I think this could be a useful question to discuss, because that could point to where we should be investing. So which businesses are doing well? Are there, if I can add to the question, potentially, how can I get invested in those businesses? I imagine we may hear a lot about logistics and perhaps fintechs, but Siri, we haven't heard from you in a while. I was wondering if you want to chime in here. Can't hear you, Siri.
I think some industries definitely have experienced booms, and most especially in the FMCG space, relative to the hospitality or the airline industry that has experienced a downturn. So I think investors definitely should look at that area. Real estate has remained stagnant as well, but I think that also affords some opportunities for more investments, and perhaps in the instance of mergers and acquisitions and corporates that hold these assets, just looking at restructuring what they hold. Some of the discussions we've had have been around real estate investment trusts and real estate investment companies. And the good thing is we just had a Finance Act amendment that awarded some incentives to that space. So one that certainly should be looked at, because some of the incentives that were afforded included just tax exemptions for that sector. So while we might have seen a decline in the sense that real estate is not fully occupied at this time and values may have gone down, there's still some leverage that can be had depending on how they are structured and depending on what tax incentives are taken advantage of. Right. So manufacturing, logistics definitely as well, and the agri space.
All right, thank you very much. And maybe a follow-up question, and either yourself or anyone else in the panel may want to, very quickly, if you can, speak to how I can potentially get invested in those industries. So you mentioned agriculture, you mentioned real estate, I think FMCGs. Apart from, of course, the stock markets, which I think is limited in terms of choice. We have limited options there. What else can we? How else can we get invested in these industries if we wanted to? Since you speak to investors all the time, do you have any ideas on that?
So I think one of the key things to consider, I would say, for any investor is really because of this and values have shifted. So I think the question to ask yourself is, where are your goals and values aligned? And you must invest along those product lines. How can you get invested? I would say it's important to understand your risk tolerance and your risk threshold. Don't just put your money in any risky assets. We talked about the agribusiness structure. Now, that is not just for everyone. You have to make sure you do your due diligence before you put your money in any of those products. You have to be really careful. Another area that we haven't discussed, and I think is something that a lot of investors are focusing on, given the climate, particularly with the currency pressures that we're seeing, is Eurobonds. Now, I know that First Bank has some products where they've democratized Eurobonds and have allowed retail investors to participate. I think that's one area that people often overlook, and it's quite exciting. The returns are in dollars. And it's also, you get some sort of like stability in terms of your currency exposure and allows you to hedge your risk. So I think that's one thing people need to look at more often. And the mutual funds that are Eurobond supported as well. So I think a lot of investors need to consider that a lot more and then see how they can participate in that.
No doubt, the Eurobond yields are fantastic. Well, strong double digits. I think they even, I'm not sure where they are now, but I think there was a time they were even close to 20%. So yes, no doubt, very, very useful tip there. All right, on that note, we really have to.
Can I just? Okay, I was just going to add something. And one of the things as well that we think should increase significantly in the Nigerian market is the use of family offices, as that provides a diversified platform for investments. So to the extent that you then don't want to crowd your funds in a particular asset class, the family office landscape provides you that platform for diversifying. And a lot more asset managers should begin to structure around that, because then that tailors, the kind of products that some of the investors would require, and also gives decent returns, again, depending on their risk appetites. Just thought to put that out there.
No, useful. Thank you so much. And we really have to end it there. Before I hand over to Daya, I just wanted to, if you like, just put out my advice there. Clearly, a lot of useful and exciting, attractive investment options have been discussed here. But I think it's so important that every listener and of course our participants remember that it's important to get investment advice as you try to get into any of these assets. Potentially, you will get in either the wrong way, in a way that is liquid, simply a way that does not fit your objective. So I want to strongly make that point, which I think unfortunately is not made often enough in this in our market, because people simply are looking for yields. It's so important to get investment advice, and please speak to an investment professional as you do that. All right, before I hand over to Dai, I just wanted to just highlight some of the results of the poll, if you like. Thank you so much for participating. Just to share the outcome, the first question was, what is most important to you when choosing an investment option? And 60% predictably say it's capital gains. They're looking for yields. 40% say capital preservation. Oh, actually, I think there's something wrong there because it can't be 40%. Okay, actually, I think people may have selected several. So 60% mentioned capital gains in their choice, 40% mentioned capital preservation, and 22% mentioned building a savings culture. And the second question is, your investments may provide a hedge for your capital. Which of these do you consider most important? You can choose more than one. So again, 50% mentioned FX hedging, 50% mentioned inflation, while 23% mentioned bad or bad spending habits. And the third question was, what are the important things you look out for when choosing a money manager? And multiple choice again. 86% mentioned all of the above, which are proven track record, regulatory compliance status, and reporting and transparency. While 12% mentioned only proven track record, while 8% mentioned reporting and transparency. So it's good to know that these are things that are most important as people are deciding on their investments or money managers. On that note, I'll hand over to Dio to share a few closing remarks and we'll be done. Dio, over to you.
Thank you, Wale. First and foremost, I must say a very big thank you to the panel. I mean, everyone knows they are very busy people, and they're all like they're all my bosses, right? So it's impressive that I could get them to agree and co-opt them into this meeting in a very, very short period. Just 2 weeks ago that we started this entire planning. So I must say thank you again to everyone, from Coco to Ini to Esiri to Abiola to Tone to Onome, and even Wale himself. Thank you, everyone. And to the audience, thank you very much for coming. It means a lot to us at ZCrest Group. And I hope you've gotten some clarity on the event of the last few months and how it has affected global economies and your own personal financial positions. We've seen a lot of responses, an imbalance of responses, so to say. We've seen developed markets come out with the big guns, flood their market with money, and support their economies to go back to growth. On the extreme end, we've seen emerging markets like Nigeria going cap in hand to get bailouts and to get aids. It's the way of it's how the world is designed. And so we don't have enough capacity to respond to the crisis in the right way, and that is the fallout we're getting now, where we have to even reopen the economy despite escalating COVID cases. It's unfortunate, but that's the reality. Well, like I said before in my previous address, when we have periods of stress, it is normal to see investors look for Hail Mary actions and miracle performers in investments. People again look to their investment returns to sort of fill the gap that they are losing from their bad businesses. And it's a problem because you have to now move from a problem to a bigger problem, and that's what we've seen over the years. We've seen a lot of losses. At ZCrest, we have a compendium of all bad stories that we've seen over the last 20 years. From Ghana, where you have about $2 billion of investors' money lost in the last 1 year, and all of these bad actors. To Nigeria, we all know about MMM, we all know about a lot of these platforms, right? Because we are desperate right now, they will take advantage of us. And that is the problem that I see coming from this. So why is ZCrest doing this? Why are we doing this? We're doing this because we think that it's a communal approach that we have to take to growing the industry and to helping everyone. We don't see anyone in the industry as our competitors. We see ourselves as collaborators and we want to work with everyone to further this mission of wealth management for everyone in the country. We think there's a very low level of capital formation in the country, which is why for any big projects, we have to look outside. We have to look for China Exim Bank. We have to look for China Exim Bank to finance our projects. We have to look for foreign investors to bring in dollars. It's because we don't have significant capital formation locally. And that is what I think the industry should be about. This slide shows a lot of bad news. 3 million Nigerians losing MMM. There are a lot of slides around it that just shows the same story I'm talking about. So that's why Zinvest is in the market. We want to join our partners, players in the space. We want to work together to develop this space for that, to bring more products to the market, improve customer education in investment management, and more importantly, we want to tell everyone that we are not the experts here. We want the customers to tell us exactly how they want to be served. So after this meeting, I would implore everyone to come to our website, leave comments for us, send us emails as to what they are looking at, and we can put all of that in our product development. So again, this is a platform for everyone. Zinvest will come to be a platform for everyone, and we'll put your trust, we'll put our competence only at your disposal. We'll do nothing to harm your wealth. We want to be your partners, and I thank everyone again for coming to this platform, and I wish everyone a fantastic rest of the year. It's been a bad period. We still hope that we'll get a fantastic close to the year. And we have to do this on a side note. We have to rush these events because we earlier believed that they would open the flights from tomorrow. And I know it would have been very tough to get people like Coco and Ini once the flight starts going. You see Coco tell you he has a meeting in Barbados. Ini will go to First Bank Congo. Same for everyone here. So I'm happy we're able to get this done. So again, thank you, everyone. Thank you for coming. Thanks for this. We'll do more of this, and we hope that we're able to get all of you together when we have other events. So thank you, everyone.
There are two types of people in this world: those who seek regulated, secured, and realistic investments, and those who don't. Many unsuspecting investors over the last 3 decades have lost their funds to unregulated finance houses that promised unbelievable returns. Don't be a victim. Be wise and notice the trend by looking at the past. Keep your funds with a regulated fund manager where you can sleep easy. Join Zinvest, a Securities and Exchange Commission licensed and professional money manager. We have helped bank treasuries, pension funds, insurance firms, and even foreign investors manage their books for the past 7 years. And we are ready to devote our financial expertise to earn you more kobos on every naira you invest. Zinvest, demystifying wealth.